What's one thing GPs think LPs care about that they really don't, and vice versa?
VCs do not care. I would say that your description of your network is one. Every company has a slide of like, look at all these great people I know. And as a reviewer, when everyone has that slide, we can just numb it out. Everyone's got quotes. Don't put quotes from founders in because it's just noise. Yeah, everyone can do that. Yeah,
Okay.
like that has no impact. Zero.
Good to know.
It is great. Like the ways you can differentiate yourself is like, and I've seen these people do this. I think it's such a baller move. Here's who I use for my references in your deck. Just this is like, don't call them, but these people are all referenceable. And I'm like, they're going to take phone calls for you. And obviously, like you're looking at the fund, and that's an amazing group of people. That is a baller way to say that you're well connected, where your references are.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have the one and only Ben Black, co-founder and managing director at Akkadian Ventures and the visionary behind the Raise Global Summit. I'm very familiar with that one. Every emerging manager is. Ben has spent over 2 decades in the venture world, backing growth stage technology companies, shaping how GPs and LPs connect in rapidly evolving capital environments, from secondary venture deals to crafting one of the most influential gatherings for emerging fund managers. Ben brings deep insight into both the art of investing and the architecture of the venture capital ecosystem. Thanks for coming on, Ben.
It's great to be here, Brian. Thanks for having me.
Yeah, I'm glad we finally got to meet. I've seen you around the community now for years, and it's like, guys, this guy I got to meet at some point. And your name came up, and I'm like, podcast. Let's do a podcast. So you've been in the game for decades. What drew you into venture in the first place? What's the origin story?
Oh, the origin story. So back in the day, I was working at a tech company, an early one, and I was part of a group that my friend Josh Becker, who's now the state senator from Palo Alto Menlo Park, created called Round Zero. Yeah, through that, it was an amazing group of entrepreneurs. I mean, if you could just invest in those companies, I'd be retired. The people that were in it, like Narav Tolia,
Would you retire? Would you really?
Yeah, I don't think so, but that'd be
I
a
don't
lot.
think any VC
I'd have a bigger house. Well, it is. Well, that's because funds last so long now. Every time you sign up for one, you're waiting for like 20 years. When do we have a 20-year liquid fund? It's going to come.
We should just call them 20-year funds, because that's really what they are.
Yeah, it really is what they are. Yeah, I've become the artist of fund extensions. I'm like excellent at it. So it's part of Round Zero, and never thought anything about venture capital. I mean, we had got taken VC as an entrepreneur, and this friend of mine was working at a firm called Rosewood Capital, and Rosewood was the original kind of hunt money from Texas. They were retail, like consumer investors, and they decided in 2000 that they wanted to do internet, but they were very much kind of like not that connected into the younger entrepreneur scenes. And literally, they gave me the job just because of who I knew through Round Zero. Like that was why they gave me a job. And after like managing 50 people and at 27, 28 years old, I was so excited at the idea that someone was going to pay me just to like meet with entrepreneurs and look at businesses. Like I was like, what a mind-blowing thing that was. So I joined to do internet investing in 2000. Then the internet blows. Like literally my first day in venture was April of 2000. Internet, then we spend just like 2 years trying to keep companies from being vaporized in the early 2000s. And then I think that has shaped my investment philosophy of like trying to avoid losses for my entire career. Because I started just going from company to company trying to save it. Funds actually ended up doing pretty well up there at Rosewood, but it was a different game. Then they decided they didn't want to do internet investing anymore. They wanted me to source restaurant or retail deals, which I had no network to do. It became like I was a fish out of water there, but I still like the investing gig, so I stayed with it.
It's amazing. And so somehow you found your way into Akkadian. What's kind of the origin story there? You guys focus on secondary transactions. How did that thesis come about?
And there's a little bit of an arc from that leaving because I would say for many VCs the aughts were a desperately dry time. I mean, I think back those days like a 2x fund was a huge win.
I got out of Wall Street, Reddit. I was doing mortgage-backed securities at a little boutique firm, and I got out right before. This is 2007. I was like, I don't like this, and so I kind of washed out. And I was teaching math up in the Bronx for the New York City teaching fellows, and then I was like, my wife and I were like, let's go to like Japan to teach English, and I got out right as like the hammer dropped there on Wall Street. So kind of similar. And then I got into ventures like roughly. I closed my first fund roughly when the sky was starting to fall in 2022. So almost like similar, just echoes of how you got into the industry by 20 years ago.
Yeah. I mean, look, this is what happened to the end of this is the path, right? So I went up to Mavron, worked for Howard Schultz, which was amazing. And I did this one deal that Andy Rappaport from August Capital heard about, and he loved it. And this one deal, it's a long story, so I should go deal to it. But basically, he put me into business as a solo GP in 2007. I raised a $26 million seed fund with Josh Becker in 2007 called Untitled Chapter. Back then, like nobody had seed funds. I mean, this is really early in
That's
that whole
pretty early
thing.
for a seed fund. Yeah.
Yeah. And so, uh, it was all the sort of double bottom line impact, very focused on sort of climate and green tech back then. And
That was very much the rage back then. The triple bottom line, people plan a
bottom line,
profit. Yeah.
and basically he's like, we need real managers in this stuff, doing this stuff, because and not so focused. People are trying to generate market rate returns and doing good at the same time. Very, very early, but we raised a $26 million fund, and 15 million of it came from a public company called Muni May that wanted to have a VC fund kind of associated with it, that did a lot of project based investing in clean tech. And when the credit crisis hit, this business, I was doing 300 million in revenue, 80 million of EBITDA. I've been trading on the New York Stock Exchange since 1985, and it vaporized overnight. And we lost 15 million of 26 million. And it was just, we already gotten like 2.5 million from them. Long story, we negotiated a very good,
Like, hey, we can't make
outcome.
these capital calls. We
We
can't
can't make it.
commit.
I was
Yeah.
like, okay, so we took their capital, their what they had invested, gave it to the other investors. Phil Blackwood from True Ventures was like crucial in helping me through this
Ouch.
terrible time.
Okay, so you did
Yeah,
the nuclear option in the LP,
yeah,
which is, hey, we're just going to give all your shit, that 2.5 million. We're going
right.
to bid it out to all the other LPs.
I
You could buy
actually got
them.
more. Forced them to pay. Gunderson was my lawyer at the time, and they earned every penny that they could possibly give, because they basically were like, look, in your LPA, you get this provision. I had never, of course, like any first time GP, I didn't know how defaults work. But you're like, this is going to be great. You
Yeah.
just like go over, it's all
I've got a
boilerplate.
couple defaults, but these are small
Yeah,
checks, and I'm just like, I'll just change your commit. Like, it's
yeah,
fine. Like,
right. Well,
you know,
this is like life changing.
this
The
is like a
lives are,
life changing
yeah. Right.
commit
How do I
changer.
pay
Yeah.
my mortgage, kind of
Right.
thing? And, so they had a $15 million capital commitment, and they had a provision that said if they defaulted, we could go to court and force them to put the remaining capital commitment in escrow. And so we were like, look, we're just going to force you to put it into escrow because they're trying to save their company. They're like, well, okay. So they agreed to pay us for 3 years of fees, and we wiped out their capital account. And then so the investors that stayed in, but I had a tiny fund at that point. I had like 3 years of runway to figure out something else. Josh decided to go into politics. So I'm just like alone, sort of managing this pile of doo doo. And Josh decided to go to politics, but ultimately it worked out pretty damn well for everyone. One of the companies was a company called O-Power. That was a CX return that 2x the whole fund. And because this is why like boilerplate matters. We not only got to wipe out their capital account, we also got their tax loss. So it was a 2x fund with no taxation.
You pass
Nothing was
through the
taxed.
loss
We
from the
passed through the
LP.
loss, netted off all the gains. All the gains passed through. Accountants were coming on, my investor that were sending their accounts with like, how can this possibly be happening? This is so weird. I'm like, nope, here it is. People are like, it was a great, turn the lemon into lemonade story. But needless to say, I was very, very down on seed investing after that experience and doing my own seed fund. And I was like, look, I'm more of a growth guy. This just doesn't fit me doing seed. So
See, it has a lot of ups and downs. It's
yeah,
not as predictable, right? It's sort of like the chaos theory, right?
yeah, no,
You're
it
gonna
really
invest to
does.
dozens of startups. Most of them are gonna flop. And
The way,
but back then, seed was, kind of how we might characterize pre-seed now, like very, very early. 5 cap, 4 cap, kind
yeah.
of
Yeah,
very
but
little traction.
everything's sub 10. Yeah, everything's sub
Yeah,
10 back
everything's
then.
sub
But
10.
we actually had a fair amount of traction at that point. You could get things sub 10 back then.
Okay.
Yeah, but the way I described it was, when you're a seed investor and you're on 12 boards, you basically have 10 companies that are trying to be like children, wander around the street, get run over. You're going from crisis to crisis to crisis to crisis. And the 2 companies that are doing well, they don't need to talk to you. So it's like seed and board members, okay, go, bye-bye, and so yeah, it was a different beast. And then I was always the guy at Mavron who, when an LP wanted to sell their interest, I would talk to all the secondary buyers. And back then there was a few of them, the Saints Capital and VCFA, and, Lake Street was one of them. I just knew them. And this guy I knew after the credit crisis, he, in like 2009, 10, he really, really needed to sell stock because he's a real estate guy, and he needed to sell like $10 million worth of stock. He had a big piece of a really good software company, is 50 million of revenue, about 8 million of EBITDA. And he was like, can you help me sell it? And I made like 3 phone calls and sold it. I called Industry Ventures. I called Ken, a few other people, and got the deal done. And then somebody came to me once that heard what I'd done and said, hey, can you help me sell this $4 million piece of stock? And pretty easy to sell that too. But it actually was, I think it was to
You're like,
Industry
hey, I'm
Ventures.
on to something here.
Yeah. Well, then a third guy came to me and said, hey, I want to sell $500,000 worth of stock. It was the CTO of this company. And I was like, look, if you want me to put together 10 rich guys in an SPV, which by the way, no one did those. Because
Very
I've
early.
been a lawyer
Yeah.
originally, like I knew how to do it. And, it was all on paper, they, I said, you're gonna have to give me a really great price. And I said, look, so, I offered him that price that was a 70% discount off of what
30 cents on
stock
the
was.
dollar off the most recent
There's the
valuation.
valuation. Yeah.
Yeah.
And he jumped in. He said, look, it's only 10% of my position. I just want to pay off my student loans. I need to get a down payment on a condo so I can move out of my college, apartment. And he gave me a hug. I've asked, can we close? And I said, I want to buy stock from guys like this for the rest of my career. Like
Yeah.
that was my
You're actually solving this huge problem for them.
huge problem, huge
Yeah.
problem. And the pricing I got was ludicrous, ludicrous. And so, that inspired me to start doing it. But it took me literally, I didn't have a fund. So my first fund was 7 SPVs, but we did DocuSign at $1.50 a share, Splunk at $4 a share. It's just some amazing deals. And that fund, was like a 6.5x,
And
DPI.
so for the audience, that's top probably 5%, for VC
Yeah.
and PE. Yeah.
So, it's, yeah, it was a long time ago. It's a different strategy.
Amazing.
It's not, but basically Akkadian really, once I did that, there's like, how do we, like, I want to basically built the business from the ground up to do very small transactions at scale. And that's kind of our secret sauce.
Well, what LPs probably like about that strategy as well is that you don't have these long 10, 15, 20-year time horizons for seed. It's secondaries can be, 3 to 5 years, which is what LPs like.
Yeah. Well, the goal with all of our funds is to try to generate, VC returns, but in a much shorter time frame. Now, it proves with 2021, we got our own time frame problems, right? So like everyone does. Like, I can't believe that I've got like 5 or 6 companies. I know four companies more than 500 million in revenue, and I can't believe, how long I've held on to them to get there. And like, why are these still liquid? That's a whole nother topic, right?
Yeah. So let's talk about the fund history. So you do these 7 SPVs, and you're like, hey, I'm onto something here. What was that raising the first fund like for that strategy?
Well, look, I mean, like the first blind pool came in 2012, and that was, just a bunch of high net worth individuals. I found like a little sort of boutique placement agent that sort of specialized in high net worth individuals. They never raised, but those deals, we had our first exit with Splunk, and that created a lot of attention because it was really fast. It was 18 months, the 5x in 18 months. So I raised a $22 million fund and did 8 million of SPVs in 2012, and then we're off the races now. We're investing out of our 6th fund, and it's, $300 million vehicle, and it's just evolved. But it's like, the industry, it's really evolved, right? And it looks very different. I mean, back then, I was literally trying to like sort of convince CFOs and CEOs that secondaries were legal. You know what I mean? That you could allow this to happen.
Well, you own the shares. I mean,
I know you own the shares. If you
the
follow
company
the
has the
transfer
first right,
agreement,
right?
yeah,
Typically, the
follow the
company has the first
transfer
right.
agreement.
Yeah.
Yeah, you have to.
Yeah.
You follow it, and then people were like, "Well, what about the rofer? Won't that keep you from doing the deals?" And I'm like, VCs are not going to get out of bed to rofer $1 million transaction. Like, they're just not going to. Like, they got to go to their GC. They got to go to their investment committee over $1 million. No chance. And we were at Rofered for a long time. We did get Rofered, unfortunately, on Twitch. That was an ugly one. Battery got me on that one. But it would have been a 10x in like a year. Because we were trying. Twitch secondary is 100 million. But yeah, those were very different times.
Yeah, that's crazy. Incredible battery to do that. How much was the transaction for? Do you recall?
I would say $3 million.
Okay.
Yeah,
It's 3 million, 10x in 1 year.
yeah, in 1
They
year.
kind of looked at it. They're like, hey,
Yeah,
that's 10 cents on the dollar. We're
yeah.
gonna buy that.
They actually called me like, dude, this is too good. I can't let you have it. And I'm like, yeah, I'm sorry, but
Yeah.
yeah,
Like a
but
shrug.
I funded the early days
You got me.
of Akkadian by getting breakup fees from Yelp. So I didn't have a fund, but I would basically knew that Elevation was going to rofer anything above a certain price. So the GC actually told me this. He'd be like, "Don't bother, Ben. You're never going to get the stock. They're going to rofer everything." And so I went around to a bunch of employees and said, "Look, Elevation's offering you 278 a share, and this aren't the exact numbers. I don't remember the day, but there, I'll give you 350, but I want a 5% breakup fee." And I would just go do these frameworks. And I made a ton of money doing that and funded my first couple years of operation.
Nice. So how
Yeah.
has the six fund, $300 million fund, like how has the strategy and the market shifted over the last, almost 15 years now?
Yeah, well, it's got, and look, back then there was like a handful of people, mostly individuals. There was very few funds. 137 Ventures started around the time. You always had industry, but they were so big that, they would ignore these little transactions. And, we obviously at times, we've come up against them, but there were a very small number of people. I mean, now, the secondary market has gotten bigger than I could have ever imagined it. And now, now you have, the mega funds that are
You got a
REAs
lot of
and
copycat funds out there that are doing what
tons.
you kind
Yeah.
of originated, back in
Totally. So
2012.
over the years, I'd say that we distinguished ourselves by being very service oriented. And like we would say, this is not transaction. Like we had developed a small number of relationships with good companies. And I was like the liquidity in the CFO's pocket. And it was all about execution and making, so we would do any deal of any size. You have an assistant that wants to do a $10,000 option exercise loan, we'll do it. And we built up this crazy back office in order to do tons of little deals so we could fully service the company. And the goal was to have like a 1 or 2 years where we're kind of the only buyer on the cap table. And then if they opened it up, the price would go up and then we would kind of move on. But that was kind of the plan. Over the years, we've just become way more concentrated. So like less companies,
Your deals.
longer relationship, bigger deals, and a lot of times trying to be kind of big, the person that handles the rofer for the company.
Yeah,
In
because
our, in our best situation.
there's these other kind of market makers out there. I think Hive comes to mind that does this now. They send out the hey, we got SpaceX at this dollar per share, and
Yeah, and a lot of those is I didn't know how to work with all those groups, and they didn't exist until in scale until really relatively recently. I mean, Zimbardo is really professionalized it. People don't know that name, but Zimbardo is they're out of New York, and they basically a broker that works with brokers and with a lot of issuers. They're very very good, and
trying to
we've
become
done
almost like the Nasdaq of the kind
yeah.
of private markets.
And then, basically our service basically is like, look to the companies is once we're in the company, we can we'll take care of, like, if you see your stock out there, they don't want usually a lot of new investors. They don't want strangers, in many companies. Some companies are totally fine with it and many companies don't. And so we'll say, look, we'll take all these, we'll actually, bring them on the inside and you'll just have one counterparty, one investor will aggregate your common. And then you just working with us is, obviously we're going to be good long-term stewards and we never resell. And so that's been how we differentiated. So our current fund, it's 15 sort of material positions.
Really?
My earlier funds were like 20, 25. And now we're super concentrated because like to create the right kind of relationships is just harder. So when you have them, you want to make them bigger. Second is I always regretted not putting my best deals in the fund. We had tons and tons of DocuSign. It was probably one of the best deals we ever did. And a lot of it was in SPVs. And now, if those deals had been in the funds, those funds would all be like top quartile funds or better. And so, I sort of hurt myself by doing those SPVs. Now it was nice because everyone got paid. We generate carry much sooner. So it's kind of good for everybody in some ways, but like bad in other ways. And so now we just try to concentrate on, and the really big advantage over secondaries versus primary investing is we can really concentrate our funds and our winners. So $300 million fund, our top 4 companies they make up 50% of the fund. And we
Because
can
you can keep buying
adding.
shares.
We
Yeah.
keep adding until finally we're like, we can't take anymore, or the price gets away from us. But we can keep adding really effectively between rounds. Once we have a company underwritten, like there's no way that even if it gets listed on the brokerage, like we should be able to snap it up really fast because we already have the price. We already know we want to do it.
Yeah,
We've
you
already
know
done the
what price to
diligence.
buy at, and you just kind of execute. And
Yeah.
so, speaking of which, what kind of companies do you look for in these stage, and how do you kind of balance risk and upside?
So yeah, so I mean, like if you look at our fund, it's we're buying high growth. Like we never have played at the very like crazy growers that just get crazy prices. Like people invest in Akkadian because they're value investors and it's a value oriented way to do venture. So we're like doing the typical company would be like $100 million revenue company growing 30% that we're buying at 5 times. That's at or near profitability. And now if we go up, if growth goes up, we'll stretch it to 7, 8 and something that's really good, that's growing really fast.
Kind of looking at public market comps, and you're kind
Yeah,
of saying, hey, if you're growing 30% and you have this kind of EBITDA margin,
yeah.
this is what you're going to probably either sell
Price
for
for
or
it.
IPO for. And so you're kind of underwriting the risk to have a little bit of upside. Yeah.
It's 3 to 5x in 3 to 5 years with a 10x case. That's the underwriting
What's
in
the 10x
15
case?
years. Oh, just the idea that this you really could see this company growing beyond that and continuing to grow for a long time. I think it's really important when you're underwriting companies, and where I really have changed over my investing in the last, as Acadian is, a lot of times I got entranced by something that was doing really well in the short term, but I didn't consider long enough the competitive dynamics over long periods of time. So companies do well for a while, and then you really want company. If you look at a company like DocuSign, we bought it at about 20 million in revenue, going into years like they're supposed to do 36. But you're like, look, every company in the world needs this product. It's got one major competitor at the time, EchoSign, which Adobe bought. And you're like, I can see this just growing and growing and growing. And you got to sort of see that. Whereas it's like, if you're in TAMs that are smaller or the competitive dynamics are different, the good run you're seeing can really end. And that's kind of the hardest part, is seeing those opportunities and getting it right.
So as an early stage fund manager, I'm investing pre-seed and seed. I'm running these 10 to 20 year funds, 10 to 15 year funds. How do I think about liquidity and partnering with Akkadian as I get into years 10, 11 and beyond? And how do I think about trimming my positions on things? What things that are marked up, generating DPI, all those kind of fund manager questions.
Yeah. I mean, so, I do a lot of talking to fund managers because of my reads. I just was speaking at the Recast Summit, I was recording with Craig, and, there's a whole session on just this. And, and I think that, look, and I'm also right now in the process, we have 1,000 funds that have applied to raise this year. So I'm going through my own set of 80 or whatever I have. Maybe it's not that many, but I have like a whole bunch of funds. I'm going through the rating process because I'm a rater.
Now that we've chatted, you have to be like, no, I was on his podcast. Here's somebody else.
It is awkward when you do get somebody that you're friends with.
Yeah, you're like, ooh, I know this guy.
Yeah, no, I think I got 3 this year that I know them quite well, and then so it's a little bit awkward, but yeah. So I think that it really stands out right now when a manager has delivered DPI back to investors, and LPs, right now they really want managers who've shown that they can deliver DPI back. And
they kind of understand it's going to take 5+ years for an early stage fund. So like they're kind of looking at years like 6 and 7.
Yeah,
right.
No one's gonna. It is very specific about where you're in your life cycle. If you're a first time fund in year 5, nobody's going to expect that.
Yeah, it'd be very unusual. Very unusual.
Yeah, certainly there are. And I think that if you have an opportunity in year 5, it will differentiate you against all the other year 5 funds.
So if I'm sitting on one of these crazy AI companies, I invested at a 10 cap and it just raised at a 10 billion cap. It's 1,000x.
Take the money off the table.
Yeah,
absolutely. And do it right before you go fundraise.
Yeah.
But there's this weird, there is a lot of people that are very hesitant to sort of force the process with the founder because they're so afraid of sort of being seen as not supportive or whatever. And I think that, one of the things you should find out that people don't about entrepreneurs is there are entrepreneurs that I've invested in that don't give a damn about your VC business or your needs for liquidity. They're hostile to it, if anything.
Well, especially if they went to YC.
Yeah. Other ones are like, they kind of understand and they're more mature and they sort of get that you have a business too, and they have some sense of empathy with you. I've got one deal, I won't say what it is, but I've been in 15 years, 14 years, and I'm like, I would love to sell. It's really hard. He makes it really, the founder makes it really, really hard to sell. And so
he's like, hey, Ben, why? Like, he just gives you a hard time, or like he has no legal way
no obligation to help. And, and I don't know. It's just political, I think, for him. And just doesn't want to bother.
What's the mechanics of that? Let's say I am sitting on one of these 100x opportunities, and I'm like, hey, they just raised a huge round. Maybe I should take 20-30% off and generate a 20-30x for my fund here on this deal.
Yeah,
basically returns most of the fund.
Not all of it.
What's the mechanics? Like, how do I go about this as a GP? I reach out to their lawyer, their
so
counsel,
usually I would start with the CFO and suss them out. All right, so talk to the CFO first and be like, good question. Are there secondaries happening? A lot of times secondaries happen, you don't even know. So be like, I'd like to know what's going on. Is the company open to secondaries? And the most important thing is to get the company to be okay with sharing information with a secondary buyer.
Well, sometimes you have information rights. I mean, maybe I should put that in my side letter, but like usually I'm such a small check that when it converts in the A to a priced round, I'm a minor check and I don't have major investor rights, so I don't get those information
Right.
rights typically.
And that makes your job even harder because if you don't really know what's going on, it's even harder to sell. But it really, it needs to be around, you need to really get them comfortable with the process. So ideally, look, the best time, the simplest way is when they're about to price a new round. You call the CFO before the round and say, look, I'm willing to provide additional shares if you guys need it, you know, and that's like not hostile at all. And that's super, that's like step one, right?
Just see if they're like, oh yeah, we'll buy him at
Yeah,
we're
and that
the 5
happens
shares actually.
all
So
the
if you can
time.
put him back into the
No, no, not
yeah.
evading it. If the deal is oversubscribed, a lot of times the founder won't want to have more dilution, so he can take more capital in, and not have it be dilutive, and bring on a new investor who says, "I want X enough ownership." He can meet that ownership target by actually just letting the seed investor sell. I'm actually selling a seed investment right now that's happened. I was in at like 10. They're selling for 160 in 3 years, and or doing around at 160. And they're gonna like let us sell it. I'm like, 3 years? Yeah,
You're
that's
gonna
a great
liquidate the
deal.
whole position, or
Yeah, so it's $25,000 deal. It's just a personal deal, but
right,
they
little angel
sure.
check. You got a
Well, angel check.
16x or maybe a 13, 12x after dilution, and you're like,
I
yeah,
got a
I'll just
big GP commit I got to come up with, so it just helps me
right.
do that. All right, so yeah,
And so
uh,
you contact them. You're like, hey, I'd like
yeah,
to
yeah.
provide some shares in the round if that's
And
helpful. Yeah,
that's the easiest scenario, right? Just
yeah.
sell into the round. The second thing you want to do is like, are there other investors on the cap table who want more exposure? Right? Simple question, not hostile, don't need anything. They're the easiest to sell to. We've done that before, right? Well, we've sold to other people on the cap table because mega funds are voracious. And if they love the company,
They'll buy every share possible. Sequoia did a tender offer recently for one of their portfolio companies. They basically offered everybody.
I mean,
Yeah.
so, they want to write a $500 million check. They got to get a lot of people to sell. The company doesn't need the money, right? So that is the next step you do. And those are easy. Like that's no problem. Now the harder part is you're between rounds. You need liquidity because you're going to go fundraise, and you need to have the transaction happen, a year after the last round. Then, look, secondary investors are really good investing on a minimum amount of information, but we need the basics. So we can do a lot of work on our own, but you need financials. And if you can't get financials, like then you're just stuck with a bunch of bidders who are bidding blind, which is terrifying, right? And so that's not great.
You kind of know basically last valuation, anecdotal information if
Yeah.
you don't have the information rights.
So you go to the CFO, you ask for like, hey, look, can I get this the updated basics as to cap table and financials? I have a very targeted process, and you want to basically, there are really good brokers. We use a guy out of LA called Nader Ashfar from Bossing Out Partners, and he's just great. He's super, super, like a super counterparties, and he's very, very careful and subtle. I mean, you can also work with Hive or, one of or Zabata does a great job too. And you say, look, I'm going to show this. I'm going to get everyone under a NDA. I'm going to let you approve. I'm going to show it to. It's going to be 5 firms, 5 real buyers. You vet the buyers carefully. And so you're not going to take any of your time. Or it would be great if you give us like a one
This is the
call.
case where I'd call you. I'd be like, hey,
Yeah,
Ben's one of the
call Ben.
buyers.
Ben's one of the buyers.
Yep,
I got a
he'll sign the
process.
NDA.
Absolutely. You make it a very truncated process and is very minimum impact on that. And, a lot of times then they have to socialize with the board. You may have board members who want to get involved in that. The deals can die there. You know, it's not worth you frying your relationship with the company to get a secondary done in most circumstances. I'm not saying there aren't some situations where that's called for, but in most circumstances, but it's just you have to manage the psychology of it. And you just have to kind of have your process and go through the steps, understand what your rights are and what the rights aren't. Like if you have Series A stock, there's no ROFR, right, on Series A stock typically. Now I'm starting to see it get in there that there are ROFRs on Series A stock.
Explain that a little bit. So, like, I'm investing on safes; they get converted to
Yeah.
preferred shares in the A, and there's no
Uh-huh.
ROFR on the A typically,
Mhm.
unless you're a major investor. Sometimes, right?
Typically, I mean, it used to be like I'm not up on every single company what's standard today, but usually there's no right of first refusal on preferred stock. That's standard, which makes it much much easier to sell because an insider knows they're going to get the deal. Because it sucks when you do all the work and some other insider takes it from you because they matched your offer, right?
Right. Yeah, you did
So
all the work, all the
yeah,
underwriting. You've made the
so
offer for 30 cents on the dollar, whatever, and
yeah.
it just gets pulled out from under you.
That's right. Which this is like the worst, right? So in those circumstances, if I know that there's a high ROFR risk, I won't even engage unless they waive the ROFR for me, But now you're getting into negotiation. Now it's getting more complicated. Like these are
Yeah,
harder to
yeah. So
manage.
somebody comes to you, I come to you, and you look at the shares and you're like, hey, there's a rofer on these
Yeah.
shares. So I want to get that way before I even engage
Before I even engage,
because I don't want to waste my
it's a
time.
waste of my time.
Yeah. So go to all the major investors, which could be
Well,
size. Yeah.
usually the company can waive the ROFR themselves without getting the consent of the major investors.
Interesting.
So,
Okay.
or a lot of times they can just do it easily. They'll just like send out like a little notice and just have the major investors sign it. But usually, if the founder wants the major investors to waive the ROFR, they usually cooperate in that instance because everyone's trying to bend over backwards, being nice to the founder and in their best companies, the companies you want to buy. Getting the ROFR waived can cause problems. The deal can die there for certain, but you're going to get a much better response from guys like me if the ROFR is waived.
Interesting. Okay.
Yeah.
These are really interesting things to know. So what patterns are you seeing out there in the current market? Who's selling,
Well, I'd say
Yeah.
that the biggest pattern that's just shocking is the concentration of the secondary market in a small number of companies. So the top 15 companies probably have 80% of the volume.
And I'm seeing this myself in just my inbox. Yeah. Hey, we have an allocation in SpaceX. Hey, we have an allocation to Stripe. I mean, these are really, really hot private companies. And
Yeah. So outside of that, you have to be much more proactive to make deals happen and they need more information. We actually looked at, I was interested in this question, like what happens to the 2021 cohort of unicorns? So for our annual meeting, we actually looked at 311 companies that were newly minted unicorns in 2021. And we're like, where are they today? And, mostly they were just at the same price. 51% had neither raised their price nor gone down. I thought was really interesting. We put them through the various marketplaces to see where can we find transactions that have happened. And only 22% of those companies have done a secondary.
is that lower than expected?
Way lower. And these companies are, you expect more to see a higher percentage of them having done at least one that I can see in the system.
Do you think
Because
it's just the overhang in the 21 super sky high
I think it's the
valuations?
concentration, the pricing challenges, plus the concentration of interest in a small number of companies. I mean, the AI companies, the hottest AI companies too, have like, tons of deals. There's a lot of transactions there. But like the whole world has moved to funding AI, including growth investors. And I think that the interesting opportunity for people is finding those companies that are being kind of thrown out, like the not companies that were native AI, but they have AI strategy that makes sense. Already a really good existing business, but it's growing, 35%, not 100%. And their pricing on those companies is way, way, way better than the AI companies. Like we can't look anyone in the eye and go buy some secondary in an AI company for 40 times revenue. Like my investors would shoot me. So we just have to say goodbye.
Kind of off
Goodbye.
thesis a little bit.
Yeah. Yeah. Like
Yeah.
we don't do that.
But they just
But
raised the
that's
200x. Yeah.
yeah, I know.
Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So, what is Build? Well, they specialize with early stage startups, especially non technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byldd.com, connect with Ayush and team, mention the Ignite podcast. Let's get back to it.
Yeah. So
A little
that's
frothy out there, a little frothy. I think
well,
we'll,
it's really the bifurcation. It's like all this SaaS is dead kind of stuff is like, whenever you can find what the world believes and they're not all correct. I think that's an opportunity where you go make money when you're against the grain.
right.
And
Non-consensus bets.
yeah.
Yeah. I look at a lot of my winners and they look weird. They just look weird. I mean, it's
Well,
almost like a weird hypothesis. Like I look at, some are just like, hey, yeah, they're just growing super fast and it's pretty clear they got product market fit. And that's a momentum investing. But I look at some of the other ones and they just have this like really uniqueness to them.
mhm.
So a lot of what I look for is just Like, what's unique about what you're doing? Is it so
Yeah.
non-obvious that people just don't, it just looks weird when you look at it?
Yeah. I once saw Bill Gurley speak at a conference, and he said something that stayed with me forever, which is like, you know, you make great returns where the parent risk is much higher than the actual risk. And
Yeah.
I always thought that was a good way to say it. Like, if everyone believes something, if everyone believes the company's great, like the value is piped in, like it's already in there, right? Like you have to go to the non-obvious place where like there's controversy. If you don't have controversy at your investment committee, it's almost a guarantee that it's an obvious investment. The price is already reflecting that obviousness, and it's hard to make money there.
Yeah. So let's talk about conviction. Speaking of, like, can you do you have a deal or two that you passed on that still haunts you to this day?
There's the one that really keeps me up at night because I passed on it for the right reasons, but it ended up being so wrong. Back when MongoDB and State was doing sort of creating the NoSQL databases. So it was, I don't know, I don't remember the years, 2015, something like that. MongoDB is a rocket ship, so I started looking around and saying, okay, well, what else is there? So we had three of them: Couchbase and DataStax. And I was like, I'm going to do the DataStax actually just got bought. It just got bought by IBM. And I was like, they're all doing NoSQL databases. And I was like, these are kind of the three up and coming companies. I think they were doing like DataStax, like 50 million in revenue, and Couchbase and MongoDB was at about 100. And I got three just amazing reference calls. I had the CIO from Yahoo, which back at the time was like 10,000 developers, the VP of engineering from Netflix, and the head of a division of Disney that had like 10,000 developers. And I went through like all three companies with all three of them. And I was like, which one do you think is the best company? Which one do you think is the best bet? Here are the prices. Like, and these are just amazing calls to get, right? And I had to work really hard to get these amazing calls. And they all hated MongoDB. They were like, it doesn't scale. I've tried to get it out of my stack. The developers love it because it's easy, but they're just lazy. Cassandra, which is DataStax, is like, that's so much more scale. And Cassandra was really big at Netflix. And then like literally like the security problems with MongoDB were massive. It's a huge, the CISO doesn't want it there. And and MongoDB was at 10x revenue. And I didn't pay $1 billion, whereas I could get DataStax at like 200 million or something like that. And so it just seemed like DataStax was the better bet. And, and I couldn't have been wrong. Like that would have returned my whole third fund. And I just lie in bed being like, oh my gosh, like this just is the worst. You know what I mean? And I still think about it sometimes. Like
And what's the
that was the
lesson there?
worst decision.
Is it kind of follow the users, the end users? If you make it really easy for the end users, they'll keep demanding to use the product, even if it's not the
Well,
best from
look,
the CTO perspective. Or
I went over this issue, at the time when it sort of became clear we had made a mistake. And my sort of mentors, the people I care about, like, look, you passed for the right reasons. Like, it's really hard to invest, and that's fantastic due diligence. And yes, the developer loved it. That's a signal that you have to really look at maybe more next time. But I'm not sure in the face of three experts that I could have invested in MongoDB.
and so you
Like
had three companies, three possible database companies in the NoSQL. What would have happened if you took a portfolio approach? Like, hey, this is a huge
buy them
wave.
all. I would have done great.
Yeah,
I
just
would
bet
have
on
done
all
great.
three.
All three, just bet on all three. And that's
This is I asked that because that's literally what I do at Team Ignite. I
yeah,
just I'll we're such a high volume investor. We do 150 a fund, and so I can go, oh, this is a trend. I'll make 2, 3, 4 bets in this trend,
yeah,
and I only have to be right once because one will go 100x and the other three will flop, and
yeah.
I still do well. That's a
One of my
25x.
one of my friends is the public market investor. He actually, when the LLMs, when OpenAI just blew up in ChatGPT, and he had XAI and Anthropic, and and then there's even talk early days that all this is going to commoditize, and there's just like a lot of strange signal around all those companies at the very beginning. And that's what I told him to do, was just, if he was going to go in the private markets, just buy them all.
Buy everything.
Yeah,
Because
because
one of them's going to go crazy.
one's going to
Yeah.
be just so huge, it's not going to matter. And I do think that's a very, but I think it's harder to do that with your VC. It's very hard to do that. I think as a secondary guy, we certainly could have.
Yeah, if you're a seed and lead investor or a Series A
Yeah,
and lead, Series B
you
and
can't
lead,
go by all the competitors.
you
Yeah,
can't do
but
that. But for me, as a little pre-seed small check, I can just
yeah,
spread my bets around.
yeah,
I don't think I
absolutely.
ever want to be a board seat taking, lead investor. I mean, I'm sure like 10 years from now, somebody will be like, hey, I saw your clip on your podcast from 10 years ago and you said you'd never do that.
Yeah, my guess is you're going to find some company and some person you love so much that they, and you're early, and you'll be like, this is the one I'm going to. But look, I mean, most VCs spend the vast majority of their time like working on boards and the good ones. And yeah, as a secondary guy, I was like,
That's another thing I never want to do.
yeah,
Like I never
no
want to
board. I was like, no boards. Like, let them do all
no
the
board.
work. I
Yeah.
would spend all my time looking for deals.
Right.
And when I
And
brought on
adding
my
value, like making intros and helping with the fundraising and doing all the
uh,
team ignite stuff that we
sure,
do.
of
But
course,
yeah,
help.
sitting on a
Be the most
board.
helpful.
Yeah.
Yeah, but for my fifth fund, I brought on Mike Dinsdale, who's the CFO of DocuSign, DoorDash, and Gusto, to be my partner on the fifth fund, and we raised Fund Six together. Everyone wants him on boards, and when I hired him, I said, "There's a rule: no boards, no
Wow.
boards." Yeah, because it takes too much time.
It does. It does. And it takes away from what the LPs are really paying you to do, which is allocate capital and find really great companies, right?
Yeah, he does. He does really spend a lot of time with the CFOs talking about like how to manage boards and like helping them come up with their plans just on a
You should
mentorish
have
basis.
professionals on there. I
Yeah,
mean, VCs are not professional board members. Some are,
I
but
agree.
have somebody from industry that, works
Hmm.
at some Fortune 500 come on the board and pay them some money and give them some equity and have a professional board. Yeah, I want to revisit the liquidity question because you said there's a whole
Hmm.
session on this, and I probably need to just go watch it, and everybody will put it in the show notes. But what are some rules of thumb when you kind of look at liquidity as a, maybe put your LP hat on? Like if you're
Oh,
looking at my fund and you're like, hey, you did a good job managing liquidity and
yeah.
selling positions, right?
I think if you can, get an exit that returns a significant portion of your fund in the first 5 years, you should do it. I think it just sets you off so much. And also learn the muscle about how to get secondaries to happen. Because guess what? You know, that is going to be your source of liquidity you going forward. It takes so long to get companies public now. You can't wait till the end, and you need to be able to show results.
Like I just got one in my seed fund that went 20x.
Yeah, I would take I would take some money off the table for sure.
It just went 20x. I got the Series A doc sitting in my inbox right now. We invested pre-seed 5 cap. They raised at 100. So I got a 20x,
Yeah,
minus some dilution. So, call it
yeah,
15x or whatever.
and what? Yeah, if there's an opportunity like at 100, now you're not going to get secondary guys like me to buy, but there might be people inside the company or new investors that
Or
will
people in
buy.
the round who are like want more
Yeah,
shares
right.
and they
That's it.
can't get more shares.
You should absolutely do that.
How much though? Like what if this thing goes to 1 billion and I sold too early?
Enough that it returns. Only do it if it's going to make it like a real move. I wouldn't do a secondary in that instance where you're talking about 5 to 100, and it's quick unless it was going to return. I don't know how much you own. I would say like you would never want to do a deal at that point unless it's going to return at least half your fund.
Okay. So you're kind of
But if you
looking for somewhere like 25 to
25,
50% of your fund,
fine,
basically.
yeah. So I would
It's
say
gonna
like
make it it's gonna make
that
a dent.
early, more like it's got to make a real dent. Yeah,
Yeah.
absolutely. But
So
if
like
you have a point,
I write 150 checks per fund, so you can kind
yeah,
of do the math there,
right.
right? If it's gone, let's just say 20x for easy math, and I sold the whole
That's
thing,
3 million. How big is your fund?
5 million.
Your $5 million fund, and you see a $5 million fund,
Yeah,
that gives
five
you
million.
60. That gives you 60% of your capital return. Yeah,
Uh,
what are you doing?
yeah,
Three
so
million dollar. That's a $3 million return.
no, it's a 20x on. You got to
What?
consider that I write
150.
25k checks.
Oh, I think you
Right.
said 150,000.
No, that would be a no
Yeah.
brainer. Yeah.
Sorry, I thought you said
What
150,000.
are we
Right.
talking about? That's half. Yeah,
Yeah.
60% of your fund. I'm writing 25k checks, so now that check's worth 500k on a $5 million fund.
Yeah. No, not worth it. I
Wait,
would let that ride. Yeah.
and then at what point do you start trimming or sell the position completely?
I mean, it all depends on where you are in your fund's life, and
Yeah, we're pretty early. Like we're
yeah.
2023 vintage on this fund. So we're
Yeah,
2 years.
no,
We're 2 years old.
I would hold on that. I would wait. I would again wait till you can return at least half your fund in a seed
Okay.
fund, and the first opportunity you have where you can return half your fund, you should do it. I have never regretted selling early, but I have regretted selling
Too late.
too
Holding on.
too late.
Yeah. Yeah. Yeah.
Yeah.
That's
So
yeah.
and so I have a rule now that was born out of the situation where I passed on something where if I get a 5x, I'm selling at least half. But my fund profile is very different.
Your fund. Yeah, we have a wide variety, 150 startups in a $5 million fund. Right. These are lots of small checks. Yeah.
Every dollar you return to investors is not created equal. If you, and by the way, like people
IRR
have different
profile
views.
is much different. If I sell that whole position now and I return 500k to
Yeah,
investors, it's like, whoa, you just returned 10% of the fund. It's
yeah,
year 2.
I mean, it's not bad, but I would say like if it's a $100 million valuation and it's rocking, at this point in the fund's life where you're still really early, I'd
Yeah.
say like around year 5, if you have an opportunity to return half the fund, you should do it.
So basically, my called capital right now is about 65%. So call it 2.5, 2.75 mil, something like that. And I would return 500K. That'd be a 0.2 DPI in year 2 or 3.
I mean, look, you're going to be there all alone. I mean, there's very, very few
Yeah.
funds
LPs
left.
will look at that and go, well, what? Nobody else has done that.
Yeah, it also just sounds that I do think that like for many LPs, I look, we have a little different view because I have a early stage fund of funds, but I don't have a investment managers. I really appreciate it when investors take, our managers take some opportunity to send some capital back because it just shows that you're thinking about us too, right? And you're not just in it to hold our capital forever. And
Yeah.
there's just a
Well,
lot of
I won't
VCs
go
that
out
are.
for my next big fund until next year. I'm still raising a public little YC focused fund that is
Mhm.
kind of like a strategy that I had when I was running a syndicate, 5 years
Sure.
ago. And I'm on my like second YC focused fund. I think for fund 4, which is our next big fund, we'll do a much more massive $100 million institutional fund. And that won't happen until next year. And then I'm thinking maybe before, like to your point, to your advice that you gave earlier, which is, hey, get some DPI in those funds before you go out.
It makes you stand out.
Yeah, it's like, hey, I got DPI. Look at this.
Yeah. Yeah. So I would say one other thing to like psychologically, because I think that exits are a different psychological issue, and you alluded to it, that, is that the moment to sell it all is going to be the moment when things look amazing. It's when everything is cranking. You're going to feel so safe in your mark in the company. But every year, a new competitive landscape and change. There can be a scandal. There can be a large defection of customers for whatever reason. And every year you're taking a ton of risk that good thing is not going to keep going. The moment where you should sell the most is going to be the point where it's hardest to make yourself sell because it
Interesting.
could be it could be, everything could be. But the reality is, I've got companies that were doing, 40% revenue that are now doing 5, and they looked great then. Right. And I'm talking about a scale, but the world changes and you can't say how it's going to change. Take the wins when they're presented to you, at least to some degree. And you're going to feel better. You're going to sleep better at night. Your investors will sleep better at night, because the absolute worst, and this has happened to me, was when I had an opportunity to sell one company for 2.5 billion in 2021. And I passed on it because my funds were looking great. And I felt great. And everyone was rocking along, and, that company is, really struggling. And so,
Such
that
good advice.
happens.
I can't believe
So
I get to do this for free.
I mean, you just have to be like aware of your psychological biases.
Yeah,
Be self-aware, and especially when you're a solo GP and you don't have anyone to call you out on this stuff.
that's probably my strength is I'm so rational to almost
Yeah.
like a fault that I don't almost have any emotion in it at all.
Yeah.
It's kind of
Good.
like, I'm like, just what's best for the fund and what's best for my LP is,
Yeah.
yeah, I love that. Like, I want to just tug on that, what you said a little bit, which is the best time to sell is when psychologically it feels like everything's serene and going up and to the right.
Right.
I'm paraphrasing you, but
Yeah, that's exactly right.
and then the question is like, hey, do I sell, this entire 20x position? I got another one in my YC fund 1 that went 20x, and that's basically a fund returner because I only did 36 investments in that fund. So that one, if I sell that whole position, it basically returns the fund, and I have
Do you
huge amount of
recycle
DPI.
capital?
That's going to be another question. So YC Fund 1 or Fund 1 is completely fully deployed. And so there's no recycling in the LPA, anything like that. So if I sell the position, it's just straight DPI back to the LPs. For Fund 2, if I sell, I'm only 65% called. There's also no recycling. So if I got a 500K check back in, what would I do with that check? Would I just send it all to the LPs, or would I say, hey, in lieu of your next capital call, I got this.
Yeah, you could set off this. You have to talk to your, CFO, fund administrator about your particular issue. So
Yeah.
I always counsel emerging managers that like recycling is kind of the best thing you can do for your funds because it gives you more shots on goal, and it really can accelerate and really like compound your fund performance. And I bring it up in this instance because we can recycle to 115%. I think maybe a less one was 120. I can't remember off the top of my head.
So maybe you could tell the
15%.
audience what recycling is,
Oh,
what the
sorry. Yeah,
115% is, and yeah.
right. So basically, recycling says when you have your committed capital, so say you raise $100 million in committed capital, but you have a recycling to 115% of that, which means as distributions come back, you can reinvest it in the fund. Because remember, if you have a $100 million fund, you're going to get 20 to 25% of your capital is going to go into fees and expenses. And this gives you an opportunity to reinvest that capital into the fund and then have that money go to work. And we actually go beyond that. So we can get, if we have $100 million fund, we can invest 115 using, that 25 to $35 million of initial capital into new investments in the middle of the fund. That is just going to totally rock up to the upside your total
Really?
returns that you can get. And it's like free, and you're covering all expenses. So your gross MOIC, if you have one gross MOIC invested based on, $100 million fund,
Multiple
you're
on
only
invested
investing,
capital for anybody listening
sorry.
who doesn't know what that is. Yeah.
Sorry.
Yeah. Yeah.
Sorry for the jargon. Yeah. Thank you.
That's good.
I'm not used to it. So you have 100 million to invest, but you only invest 80, you need to have what X return versus if I,
You got to have a 1.25x just to break even.
right, exactly.
But if you recycle 20 million, if you have 150, 120%
Then you got to turn
clause,
around capital. And then
you
what's the return on
basically
that?
set yourself up. So you've recycled. And so the way it works is if the clause is 120%, it basically says, hey,
You
the
can
first
invest.
20 million of distributions that come in, you can reinvest.
Right. Well, it's more than that because it's the first 40, because you get to cover your fees and expenses to get back to 100. And then you have another 20 million you can invest to keep going. And then you get the return on that. Right. And that really, really ultimately improves your overall fund performance.
What's a good rule of
Massively.
thumb for my kind of strategy, the 150 per fund?
I never see seed investors talk about it, and I think there is a longevity to the problem with seed investors and recycling is the duration, right?
So
So
long. Yeah.
if you are getting money in year 8, it's in year 9, it's kind of hard to reinvest it on another time year track. But for guys like us, it's like much easier to do. So I don't see it in a lot of, I see it in Series A funds. I don't see it in seed funds pretty much at all. So it's
I
not
could
not
recycle a little
impactful.
bit and use it for reinvestment
Right, to cover your fees and expenses.
and hit my pro rata too.
Yeah, yeah.
Yeah.
So that's that it's a great thing to do, and people should definitely do it.
That's
But it
interesting.
does make the reason why I brought it up was because the calculation is like, if I am selling something and let's say I'm giving up a 2x return. So I have a $500 million exit and I think it could be $1 billion, right? But I'm taking that money in and I think I can get a 5x return on that capital. Then it's just flat out rational
Right.
to invest to
That's
sell
more than
to sell
2x.
the 2x. Yeah, it's quite irrational, but people don't think about it that way, but we do.
That's really
Yeah,
interesting. Yeah. I haven't thought about it that carefully. I was just told by lots of different advisors for Fund One, just don't worry about recycling,
yeah.
and
No, I think it's probably right.
yeah. And now, but when I get to $100 million fund with reserves and follow-ons and pro
Yeah,
rata, maybe I need to
then you're
start
good.
thinking more carefully
Yeah.
about it. Let's talk about Raise. What was the impetus for Raise? Tell us the origin story and tell us what it is and all that.
Fast forward to 2013, I had created New Cycle Capital, my seed fund, and it to I would say institutional capital, but I got it to a scale right that worked as a business. And then I had done Acadian, and at that point had created a second totally strategy where I had institutional investors in Acadian. So it made 2014. And everyone was coming to me back then saying, Ben, how do I start a fund? Like, how does it work? Because I was like one of the only people that started two funds with two different strategies and gotten them, to the point of having a viable business. The first raise was simply like my LPs and a bunch of VCs I knew who were interested, and it was like a how to create a fund. I mean, it was very tactical.
How to
So it was
raise.
a zillion.
Yeah.
Yeah, it wasn't even fact office, well, how to read your LPA, how to understand taxation issues, how to hire people, how to fundraise, how to, all that kind of technical stuff. Very, very tactical. And I had a extra room that I didn't have any content for. And I was like, well, what am I going to do in here? I said, well, I got 40 of my own LPs here. I'll just like let 10 of my friends who are in market go pitch them. And so it's something to give them something to do while we're talking about boring things in the other room. Well, when that pitching started, literally, I would say 80% of the people left the, conversation on back offices and went to see the VC's pitch, which something I was totally not prepared for. There wasn't enough room. I hadn't gotten the permission from the GPs to like let other GPs watch them. It was a mess, but it did tell me that is where the market is, right? Like that's where the market is, and that's what the market wanted. So the second raise was just where it's demo day for VCs, and people are like, well, VCs won't want to stand there in public and talk about their fund performance. Some said no in the early days, but things change.
And what, how has it shifted over the years? I mean, this is over 10 years old now.
Yeah,
Why do you
and
think
it
it
was
resonated so deeply? And, how has it grown?
when everyone knows that fundraising is the most difficult part of being a VC.
The
And
hardest.
frankly, it takes the hardest, it takes the most time. And so the vision was always, could we put, I wanted to create a room where for once the VCs were like the belle of the ball. They where there was three GPs, three LPs for every GP that was there. And it took me 9 years to get it to that ratio. Because getting LPs to like come out to anything is really hard. But we made it a little bit better, and we really created a day to be very LP focused. Like it's focused by focusing maniacally on the needs of the LPs and to make it a day for them to learn. And I'd say like we want to have the most impactful day for an LP where they're going to learn more in one day about everything that's going on at the cutting edge of venture, have the best networking that they could possibly have with a curated group. But it really blew up when I created the LP selection committee. Before that, it was basically like, we just, we're the judges, and I had some LPs that helped, but it wasn't like a public facing thing. After COVID, I was terrified we weren't going to be able to get LPs on planes. I said, how can I make this better? I said we did two things. One was we opened up the application process to the whole world. So before it was we targeted who we invited based on that was like who we knew to some degree, all the organizers. I had a whole bunch of people helping me. And when I put that sort of all the tiles up on the logos of like the LP selection committee, then the applications went crazy. And we got 500, 700, 900, now we're just about 1,000. Which is a pretty good proportion of emerging managers if you think about it, right? So, and of course,
yeah. Like how many emerging managers are there? Like 3,000, 5,000? I don't know the exact number.
I don't know. I've seen anywhere from 2,000 to 4,000 as numbers, but I don't know who to believe. But and it was one of those virtuous cycles where the more quality LPs we got to show up, the better GPs came, and the better GPs that came, the more quality LPs show up. And I will tell you that this year the funds are crazy good. Like it's
I watched the webinar, the example you gave of the best deck.
Yeah.
Which I really love.
Entree from Cantos.
Yeah.
He let me do it. I had to control him.
I was like, this guy's been at it for 10 years,
It was my favorite deck. Also, do you know Ian? He's just like the best guy. And his deck was beautiful. His wife designed it. And I was like,
it's a beautiful deck.
It's beautiful. It's so easy to read. It has just enough information, but not too much. There's places you can dive down into the company case studies. It's so phenomenally done. And I still use it this day. In fact, I'm sending a guy a pension that I'm talking to about emerging managers. He wants to see that deck. So,
And when I saw it, I was kicking myself because when I designed my deck, years ago now, like 3 years ago for my first like 10-year fund, because my first one was like a little rolling fund, but my first like real fund, I was told that, hey, you should have a white pitch deck, white background, black text, because these LPs are going to print it off in their offices. They're old school. And I'm like, I really want to go black. And then when I saw that the favorite deck at Raise was a black background deck, I was like, I was kicking myself.
Funny. I thought it never occurred to me. I would say that you can do white or black. It doesn't matter, but simple and clear.
Simple and clear,
not too much text and not too little text. But most importantly, be extremely professional in how you present your track record. We literally, the LPs will we have like this committee of 70 LPs now. We all get together and kind of compare notes, right? And they will just absolutely trash the deck if it says things like projected 10x fund, you know what I mean, on their track record. I mean, it's just be professional, do it like Cambridge Associates says to do it. No fluff. Well, but you should put your whole schedule of investments in there and be like in a proper format. If you recommend that, some people, most people don't do that.
18 investments.
Yeah, it wouldn't work for you. It would not work for you. It would not work.
I do actually fit all the ones in the current fund I'm raising, because I'm raising fund 3 right now and I have 48 investments. I do put all those in there because, hey, if you're going to invest in fund, you got to know what's in there.
It just tells an investor that you are professional. It tells an allocator you are a professional. And I just am so shocked, even by funds that have very good numbers, the way they present their track record. And every year, I just be like, terrible track record, terrible design. I knock out fund after fund for that.
Yeah. How many? The weeding out process here is 1,000 to 100, right? So you got to cut out 90% of what you see. And so some are just like poor design, poor presentation, made up metrics.
Well, when you're talking about that level, I'd say that like 30% of the decks are just easy to kick out on the second you do it. And then there's, it's really, really hard to get to 100.
Yeah.
And it's and the difference between 100 and 150 is very small. And so a lot of subtle subjective stuff goes into that. I think that one of the things I didn't expect was how upset people get when they don't get selected, and how much, I realized I created a conference where I piss off 900 funds a year. Like, this is kind of dumb. And that has just been the side. But then again, the LPs love it, and the people who get to go there are like, it's life changing for them.
That's what they want
And
to.
many
That's what they
change.
want to do. They want to show up and
Yeah.
see the best GPs.
Yeah,
You
I
know?
mean, like this guy I know who I just think is a great guy from Mexico City. He's got this LATAM fund, super pre-seed.
I
It's
think I know
$20
who you're
million
talking about.
fund.
Yeah, yeah, yeah.
He got a $500,000 commitment in the buffet line.
I've heard that story.
One conversation. I was
Yeah,
like, that's the best. That makes my day. I
yeah.
just love it.
Send me the LP.
And I love new fund managers. I think it's so interesting to watch them. I
Yeah,
think they tell you so much about the world of in venture, and where it's going. And we see every trend first, because we aggregate all together what the LPs are interested in, what the GPs are doing, and you see funds that have just such crazy performance that you want to quit, and just you'll be like, I'm just going to invest in those guys because they clearly are doing something right. I think with multiple, I think with multiple. I mean, like I don't know how many, at least 10 to 20 10x funds in there, and one's a 20x fund plus.
wow. And this is net
Realized,
TBPI
yeah,
or
yeah.
net DPI. This is DPI.
No, I think that one's DPI one.
Wow, that's incredible.
So yeah, and so and so the competition out there is just brutal, and the
Yeah.
choice making is brutal, and we just do the best we can. But we're all human, and
Yeah.
it's all subjective, right?
Yeah. I'm starting to get some early results from my fund one where I'm like top decile in TVPI and stuff like that, even though, those rolling funds have so many front loaded fees and I'm still top decile TVPI. That feels good because they,
Well,
they just
yeah,
take the entire management fee and just escrows them like
yeah,
immediately.
yeah,
So it really hits your IRR and your
yeah.
TVPI.
That's rough. That's rough.
Yeah, it's pretty rough. Yeah, because my MOIC is like 80% in 3 years and my TVPI is 25.
Yeah.
So
Yeah.
that's the fee hit on the front end.
Well, you can always footnote that, and I think that, I mean, I tell you, the place where I think the GPs and LPs are like most funny at odds with each other right now is that LPs don't believe any of the numbers anyway.
Yeah,
They think all they think all the marks
everything.
are BS. They
Yeah.
think all the marks. They don't believe the benchmarks. They think the benchmarks are BS.
Mm.
Everyone's like, because of 2021 and all the craziness that's happened since, and the way the companies can hold themselves at cost and your ability to sort of keep things, the LPs are like, we don't care about the benchmarks. I mean, literally, my LP coach told me not to put the benchmarks into my annual meeting because nobody believes it anyway. I'm like, oh, it's a view. Okay.
Interesting. Okay.
Yeah, that was the
Good
first.
to know. Because
Yeah.
I put the benchmark in there. Maybe I need to take it out. But
No,
one thing
I'm not saying you do. I'm saying
Yeah.
that's a view of an LP. That's just giving you like the skepticism that
Yeah.
LPs have towards numbers, which
Right.
makes the assessment even harder.
One thing I did after I watched that webinar and I saw that beautiful slide deck is we're gonna go revamp the slide deck back to black. It's in your name. Yeah, no, I'm like white background. I'm looking at a computer right now. I have 3 screens and it's all black background. Black
Mhm.
background on my notes for the podcast, black background on the desktop. I just like black backgrounds. I have a black shirt on. I wear dark shirts. I can't believe they talked me into doing a white background. It's like it's squinting. You got the floaters and stuff.
It is. I agree. I like the black background.
But one thing I did is I actually went and simplified the deck dramatically after that webinar. So thanks for doing that because I basically took this like monstrosity of a deck that was 30 or 40 slides with all these
Yeah.
appendices and all this like extra data. And I was like, no, what's the core like thing I need to
Yeah.
communicate with each slide and just take everything else out?
Right. Yeah. And we're looking, I mean, I'm looking for like 7 slides.
Yeah, 7 like YC style decks, right? Just very
like, it's
simple.
very, very simple. And the one place you don't want to skimp the words is in your own background, your own
Right.
bio, when you're submitting to raise, because it is, sometimes people just put logos and that's not enough. Like that's the one place I really do want to have the detail. Like what have the people done? One of our things is personal achievement. Like, and you should definitely have personal achievement in there.
That makes sense. So what's one thing GPs think LPs care about that they don't really, that they really don't, and vice versa?
Well, that's my benchmark point for that. I think that's really important. VCs do not care. I would say that your description of your network is one. Every company has a slide of like, look at all these great people I know. And as a reviewer, when everyone has that slide, we just numb it out. Now because and everyone's got quotes. Don't put quotes from founders in because it's just noise. Yeah, everyone can do that. Yeah,
Okay.
like that has no impact. 0.
Good to know.
It is great. Like the ways you can differentiate yourself is like, and I've seen people do this. I think it's such a baller move. Here's who I use for my references in your deck. Just this is like, don't call them, but these people are all referenceable. And I'm like, they're going to take phone calls for you. And obviously, like, we're looking at the fund, and that's an amazing group of people. That is a baller way to say that you're well connected.
So basically, put the most impressive referenceable people in there that will speak highly of you.
But don't
And the
put the
more impressive
quotes.
they are, yeah, here are my
Yeah.
references. You know,
Here are my references, like right in there. And
please ask
I've only
for an
seen it.
intro before you call them.
Oh no,
Yeah,
no, don't call them without my permission. Like,
yeah, yeah.
here's my references. That was in an appendix, and I just thought that like that was and the list was amazing.
Right, because the good LPs that are writing $10 million checks are going to do that anyway. They're gonna call some people. Yeah,
And so you might as well use it. You know what I mean? And so be like,
put
this
it
is
right
what
up
I'm going
front.
to give you. Yeah.
Yeah,
And it was like 20 amazing people. And I was like, ooh, God, these people, they have to get permission from all these people to put them in the deck.
right. Yeah.
And that's just so cool. You
That is
know?
really cool. That's a
Yeah.
good idea. I need to kind of flex Team Ignite a little bit because Team Ignite's so large now. You know, we have thousands and thousands of people. I have lots of incredible people there. That's a really good idea. Thanks for that.
Yeah.
Free education brought to you by the Ignite podcast.
Yeah.
So what's next for Raise? What's looking forward, you know, like,
Well,
5 years, 10 years?
the big change we made last year is I hired Scott Dubin, who was, to run it, and he's doing a magnificent job. Like, he's already making it so much better than I can make it. So, we're interested. This year we'll do a raise in Helsinki. We did one in Costa Rica. We're interested and I think that we do them internationally. It's called Raise Global because I want to build bridges all around the country between
Yeah.
GVs and LPs.
Do it around
I
Slush
also,
or
yeah,
stuff like
we're at
that?
Slush. Yeah,
Yeah.
we're doing it. We do a raise at Slush, and we did raise Costa Rica. I think we'll probably do a Mexico City one next year.
I
And
keep hearing great things about Mexico City. I
yeah,
need to
it's
get down
awesome,
there.
and it's
Yeah.
got a really cool VC community down there, and also, frankly, I think that more American LPs are going to start looking to emerging markets as well for additional exposure because those markets are really maturing. Have you been to Dubai? Well, I've been to Dubai twice so far this year.
I've not been.
And we have an idea to do a raise in Dubai, which would bring, but I think pretty epic, an
Yeah.
epic thing. We obviously do this only when we have the right local partner, and I have a potential local partner there that would do it there, and I think that would be an epic thing to do. To get like a sort of who's who's got the best of the best of raise managers to go over there all together. Be super fun too, because Dubai is a blast. So that'd be pretty epic. Then we're going to continue to expand our LP only events, which basically just did one in New York. Guess what? LPs just like to get just LPs and to compare notes. And we have our own fund of funds now, so that is great for us and to meet all these LPs in that context. Those are much smaller events. They're not, it's not. There's no real business logic to them. We sort of break even on them, but it's really good for connecting the LPs to the brand and to the
Fund of
larger.
funds don't like us.
Oh, yeah, why? Because you're creating that much diversification. It's so early.
Yeah.
Yeah.
I've talked to multiple fund of funds, off the record and kind of on the record now, but they're like, yeah, like you
Well,
should probably find family offices that want to do like Series A and B pro rata.
Yeah, no, if you're doing that many companies, the fund of funds, like they provide diversification with their layer of investments, right? So our fund of funds is, going to have a portfolio of 400 companies, and that's what we're doing it for, right?
Yeah, if you invest in
And
our
so,
fund, it's like another 150 companies.
yeah, it gets too diversified.
Too diversified.
But there's room for lots of people to be successful in this business, and that's
that's what I love about ventures. There's so many different slices: the secondary, the fund of
so
funds.
many different slices,
so
so many
different
different
ways
ways to be successful. Yeah.
Let's wrap up with a quick rapid fire.
All right.
What's one overhyped trend in VC or LP that you think we'll laugh at in 5 years?
I gotta say, the one that's making me nervous right now are all these VCs trying to do roll-ups of legacy businesses to put AI on them. I've just seen so much of it recently that I'm like, I'm sure some will work, but that's a very different skill set than VCs are traditionally good at. So I hope that they have their operator hat on, but I've seen it enough that I'm a little worried about it.
Yeah.
So
it's a plumbing business, but with AI.
I know. So I just feel like that's a trend that could be overdone very quickly, given the amount of capital and the skill sets. I think that roll-ups are a completely different skill set. I also worry, frankly, about sort of the political ramifications of, the world hates, like the rest of the mainstream hates VC enough. Now we're going to go take over their businesses and put them all to business.
Why do you think they hate us so much? Is it because we are disrupting old, mom and pop kind of industries or?
Oh, I think that there's the people who are the standard bearers for venture capital. I'm not going to name names, but don't have much of a tone that is going to play in most of the rest of the country. And they're sitting there, off of their yachts and boats. And people hate anytime that person starts to, VCs will start prognosticating about geopolitics. You gotta wonder what gives them the right to do that. And I think that a lot of people are just roll their eye at VCs when they're doing that. VCs love it because they just thrive in the attention. The more attention, the better in the VC's mind. And the rest of the world just kind of looks at it and is like, that's kind of a joke.
Yeah. Yeah. Venture
And
capital
then
is
now you
starting to
got
become
VCs going into
mainstream a little bit
government.
too.
Yeah,
That's
VCs going into government, right? And like that's created a whole set of problems, right?
yeah.
Yeah,
Yeah. You're talking about like Sachs
yeah.
and some of those guys, and
I mean,
yeah,
more power to them. I mean, I get it, but I just think that
yeah.
like,
You're becoming part of the establishment, which
no,
yeah,
VC. Let's talk about the bigger problem. VCs are keeping their best companies away from the public markets,
right.
right?
Yeah.
So the public market can't access these
Right,
companies.
which
So like,
which hurts
if
returns of
you're
just the average folks.
if you want to get into SpaceX, if you want to get into OpenAI, if you want to get into Canva, Stripe, how are you going to do it, right?
When
And
the
so their
growth
own
is gone
people,
and the IPO at $1 trillion.
right? And do you think that's fair in their people's eyes? It's easy for a VC to mega fund to write a $500 million check. That company should have been public. We're a part
Yeah,
of a larger
Amazon went
system.
public at 400 million.
And we're literally keeping our best companies now locked up in the private markets because the private markets are so amazing for the companies and for the VCs.
Right.
It's and so like I think that caused a lot of hostility as well.
Yeah, it's a little cherry picking in a way, right? I'm going
Yeah,
to cherry pick the best companies and keep them private until they're worth tens of billions, if not
yeah,
hundreds of billions of dollars.
yeah.
Yeah, it's
That's
pretty sad.
I don't know, like we're just in our own bubble, right? We're in our own echo chamber,
Mm.
and we just don't really appreciate like And so I talk to my brother and my family back in Rochester, New York about this stuff, and they'll be like, "This looks like a scam. It's not fair. It's just the rich kids are getting richer," and then they got a point. Like, what can you say?
Yeah, I mean, how do you unlock that access for the average person? I mean, you have to make it available in their Fidelity accounts, right? So they can allocate something to private equity and venture capital.
If there was only a solution.
Only somebody had a solution. Yeah, and I think people are starting to try, right? There's some asset managers out there that are trying to make that available as an asset class to
Well, you could buy an
yeah.
interval fund. You can buy
Yep.
an interval fund, and that's quasi-public. That's that, and there you can buy. There's ETFs like I said, really more mutual fund, like the private shares funds, all private companies. So there are vehicles to do it. But my guess is that there is going to be a lot coming down the pike in the future, allowing those because the Trump administration has come out and said that they want to increase access to venture capital for retail investors. So I see a bunch of deregulation around that space that will create a lot of opportunity.
Kind of opportunity for fund of funds, actually.
Yeah,
Yeah.
totally. So I think
But hey, we're a fund that invests in all these. You can't, as a retail investor, figure out which GPs to invest in, but we'll do that and create basically mutual funds.
Yeah, and so I think that that's going to happen for sure, and that's space that's going to continue growing. So I'll tell you the one other thing that came up this I think about in our LP only summit was just the dissatisfaction with the mega funds among a subset of LPs who are just abandoning them.
Mm.
And that's, I think, the best advantage. That's why they're joining Raise. It's why they're joining the community. We had many LPs who were like, I won't do any more the mega funds. I just want to find smaller niche managers. I'm hoping that trend continues. Overall, the amount of dollars has contracted and the mega funds have taken ever more money. But I'm hoping that as the returns for the mega funds with their scale, get more and more pedestrian, do LPs start abandoning? I mean, we've heard many sophisticated family office, like not single family, but like multifamily offices, like REAs managing wealth, where just I'm out, and that's a new thing that I think is interesting to watch.
That's interesting. Why do you think they're pulling back? Is it because the mega funds are just amassing too much power and demanding hey, you have to write this check and we'll decide how to invest it?
Well, yeah, if you want to go in, you have to be in all of our things, and also just like the scale, the ownership required, the scale of the investments they have to make. If you have to deploy a $10 billion fund and you own 20% of a company, the amount of market cap you have to create is just simply crazy to have good fund returns. So the math starts to break down above a certain size.
Small is beautiful. Small is beautiful.
That's right. That's what both you and I are totally aligned on this.
Yeah, no, it is. I mean, you've seen the data that emerging managers are disproportionately top decile, top quartile, because you can just sneak your way into the best deals with small checks, and you work harder, I think, too, in your first few funds. But I could talk to you for another like 2 or 3 hours. I know we're out of time. Where can folks find you online and apply to raise if you're a VC, or just find more about you?
Yeah, well, for Raise, the applications are done for this year, but if you just go, to typing Raise Global, you'll come up right to the
Is it the same
website.
application for all the locations around the world, or?
So those we do on a much more targeted basis. You can't apply. So you can apply if you're a local VC, you can apply. But for the VCs I'm going to put on a plane, I basically pre-vet them with the LPs about who they're interested in, and that's sort of you can't really apply to that. It's a much smaller number. I've been talking about like we had 20 GPs in LATAM. I think I brought 5 down to Costa Rica with us. But we may expand that. And on Twitter, I'm Benjamin D Black. LinkedIn is probably great place to reach out. I do, as Brian, you've reached out to me on LinkedIn, so I do answer.
Yeah, no, that's how you got on the pod. I was like, hey, I should have been on the podcast.
There you go, and I do watch that. It does work, so that's been great.
Well, thanks so much for coming on, Ben. I really enjoyed
It's
it.
been great. It's been terrific. Thank you so much.
Thank you.